Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. I don't know if it's because of load shedding that the streaming on that soundtracks, the music and all that plays sounded a bit strange. Maybe it's just to me. But nevertheless, all the way from Kimberley from our side this morning, very fresh this side, as I believe in most parts of the country. Our session today should prove to be uber valuable, where we are decoding some of the highlights and the thoughts of the recently held BCI Global Investment Conference that was held on 8, 9, and 10 May. There was a huge amount of information that was shared by all our great presenters, and some with opposing views on various asset classes. Hence, the reason for the session today is to try to make sense of some of those views when you start constructing portfolios for clients. Joining us this morning from Boutique Investment Partners to do exactly that and unpack the conference a little bit more is Managing Director Pierre de Klerk and Chief Investment Officer Tevonga Shavize. Tevonga and Pierre, good morning. Thank you so much for joining us today. I'm in particular really looking forward to the session. We've got so many questions. You know, when you really get down to it, when you build a portfolio for a client, whether it's a cautious portfolio or income or global flexible, doesn't matter. So many questions still, you know, what do I do? And we're really looking forward to your views and trying to bring it into the fold when we think of clients.
Thank you, Eugene. Good morning, everyone. We're looking forward to exploring, or reviewing rather, the main points that we covered at the BCI conference early in May, as Eugene has mentioned. I'll kick off our session by just having a quick overview of, the key discussion points around fixed income, as well as real estate, and I'll be covering these asset classes both locally and globally. I've got quite a lot of, material to just go through, especially for the section. So I think to just also help you to keep up with some of the discussions points myself and Pierre are going to be going through in this section. I'll put up slides and it will also be through a discussion. So whilst I put up my slides, I'll just hand you over to Pierre for a quick intro.
Thanks, Tevonga, and thanks, Eugene. So as Tevonga said, we did a good analysis of the speakers and the presentations at the conference, and there's quite a bit of material to get through today. So we'll proceed at brisk pace, but we're going to basically cover it in 3 sections, looking at the views and the highlights from fixed income and property. Thereafter, I'll speak briefly about SA equity, balance funds, and hedge funds, and then Tevonga will wrap up with the views of the global equity managers. So let's kick off with Tevonga on fixed income and property.
Awesome, thank you, Pierre. So I think many of you will be aware that in the fixed income section, many fixed income managers are quite heavy on macro views. So I'll start off with just the basic, or the most commonly referenced macro views throughout this the conference. So I think if we start off with that, I think there was a general agreement across the panel here, if you agree with me, that most supply side pressures on global inflation have dissipated. So it's really no longer a supply constraints issue, but rather it's a case of aggregate demand being quite strong, especially I think the realization that on the back of last year, there was a very strong expectation that global demand would weaken materially, and it has proven to be far more resilient than expected. As a result of the resilience of global demand or economic growth, the risks of inflation remaining quite sticky in the current environment are very elevated. So there's a very high chance that the disinflation process will not be as fast as investors want that to be. And then I think on the back of that, disinflation process is very slow and very frustrating. And I really think it's because economic growth was coming off such a high base. So to expect it to weaken as if it was weakening from average levels, I think was probably one of the biggest, misestimates, by global investors. And then what also came out of that is presently the market is still very optimistic that we're going to have a very fast disinflation process that is actually going to be strong enough to encourage central banks to cut interest rates this year, as early as this year. But if you look at the Fed's dot plot, one of the things that you can immediately pick up again, which is something that was referenced throughout the conference, is that that dot plot is far more hawkish if you compare it to their dot plot of last year. And this, by the way, again, as the speakers reminded us, is after the Fed delivered one of the most aggressive rate hiking cycles over the last 40 years. And then on the back of that, some of the key points was that rates are likely to remain higher for longer than the market is prepared for. And some of the managers went as far as saying we may be transitioning from a lower for longer global cycle of the last 10 years plus to a new regime of higher for longer. The banking sector challenges were referenced by pretty much everyone across the board. And I think the key point raised out of that is that because of very high interest rates, the flight from deposits or bank deposits into money market funds is going to remain very, very elevated. And I think many South African investors are aware of this battle between banks and income funds. I think it's pretty much the same thing. This time around, banks are on the losing end. And in South Africa, typically banks are on the winning end. But generally, what that would result on a global perspective is that with very little deposits in the banking system, there won't be enough to loan out to participants in the economy, which was, I think, noted as a headwind. A few of the fixed income managers estimated or quoted rather estimates of what the restricted lending would be, the impact of that. I think the general number being quoted throughout the conference was that this is equivalent to another 50 basis points of rate hikes. And it was also noted that we are having an additional 50 basis points of rate hikes after the aggressive cycle of last year, and also after your M2 money supply has shrunk meaningfully, which is another form of tightening in financial conditions. So generally, looking at a backdrop where the headwinds against global demand are as fierce as at any other point in the cycle. On the local front, look, I mean, the South African macro picture was generally painted as one that has deteriorated significantly since the last conference. And I think the one common thing was our energy crisis. But in that, what you picked up from the fixed income managers and even across the conference was that a lot of the managers were very keen to emphasize that the window period for Eskom to remain the major domestic macro headwind would not last longer than 3 years. And a few of the more bullish managers pretty much also said the winter season of this year from May to August was likely going to be the worst point, and after which things would get better. One of the arguments used for that, if you look at the second bullet point, is that the average energy deficiency throughout many of the load shedding, periods, so far this year, has been a deficit of about 7 gigawatts. And then there were quotes that in 2023 alone, the private sector is likely going to bring 4 gigawatts on stream, which is more than 50% of the deficit. And I think the reason why a lot of these statistics were quoted was to really remind, I think, the audience that as much as this is a major headwind, it is probably much closer to its worst than it is to the beginning. And this whole argument of a lot of negative issues, I think, Pierre, being observed or argued as being more late stage than early stage was common across any risk. I think that you sort of that was mentioned or that investors could be occupied with. So from a global financial system perspective, it was also noted that things are starting to break, and these particular points were really raised to remind us that we are no longer at the beginning of this headwind, we are closer to its end. So I think it was just a reminder to say, as much as these are very significant headwinds, the time to remain extremely negative is pretty much running out, I guess, at the more late stage you are. So when it comes to interest rates, I think it was clear, it was argued that we are much closer to the end of it than the beginning of it, hence that constant caution to say a lot of the headwinds are close to expiring. So a lot of the risk appetite also has to start thinking a little bit more opportunistically, I think. It was also argued that from a business cycle perspective, we're late cycle, and many of the managers reminded us that during the late cycle, or else equal, there is a high frequency of negative investor surprises. And that's essentially the time to start sort of changing the mindset from being bearish to being bullish. On a currency perspective, I think the general agreement there was that many of the headwinds we're facing now are bullish for the dollar over the short term, but because a lot of these factors are late cycle, when it comes to the medium to long term, it will be dollar bearish, and then it would obviously be the opposite for the rand. And I think the final maybe macro point worth noting is on global capital flows, where again, a lot of the fixed income managers, as well as the other panels, we're very keen to remind us that in terms of global investor capital, South African emerging markets are pretty much at historical lows. Again, the other point to say, if this is late cycle, it could inflect positively at any point in time and create meaningful support or tailwinds to South African assets and emerging market assets. So if I have to maybe summarize a lot of this, there were no new risks mentioned from a macroeconomic perspective. I think it's the same things we've been dealing with for the last 18 to 24 months. But the key message I think I can take out from this is that there are very few, if any, risks which I mentioned, which are early stage in the cycle. Most of this is late stage in the cycle. How long late stage is, I think everyone was very unclear, but that a lot of the issues are quite mature. So I will just maybe pause, Pierre, and just check if there's anything you want me to further emphasize. Otherwise, I'm going to just quickly move on to the asset allocation implication on the fixed income and real estate section.
No specific questions from me at this stage. I do have a question that I'll ask at the end, but I think let's proceed.
Okay, perfect. So from an asset allocation perspective, the first point made was that local fixed income, global fixed income, local real estate, global real estate, these are now all very healthy and very reasonable alternatives to equity. So pretty much it was declared that the TINA era, TINA really being, I think, like an acronym for there is no alternative, that was, I think, declared to be over. And then I think the second part, which is obviously a good follow-up from that, was that underweight global cash and underweight global bonds is no longer the obvious asset allocation decision it may have been. And I think also on the local front, I think this also came up quite a lot. And then I think cash, especially relative to the last BCI conference, was considered to be attractive, not only for capital preservation, which was the main argument at the last conference, but this time around for very good yields, or else equal. So I think I guess the asset allocation space has been reset and equalized. I think every asset class has got a fair and decent opportunity compared to any other time, I think, in the past couple of years. Most of the fixed income guys, or one or two of them, were very, very, I think, interested to stress the importance of the difference in portfolio construction strategies at the early stage of the rate hiking cycle compared to your portfolio construction approach at the later stage of the cycle. I mean, one common example which was given was that as you're beginning the rate hiking cycle, it is a lot more difficult to embrace duration risk. But when you get to the end of the duration rate hiking cycle, duration risk becomes very, very appealing. So in not so many words, much of this portfolio construction statement really was trying to point at how duration risk is probably at its most optimal entry point, or else equal. There was the discussion, I think, Pierre, of entry points and entry strategy. So I think throughout the conference and throughout the fixed income and real estate section, it was very clear that there are now a lot of good, well-valued investment ideas. So that was not debatable. If anything, discussions are more around buying than they were around selling. But what was also extremely clear was that as much as pretty much every asset class was acknowledged to have very good entry points, it was also emphasized that having a good entry point is not the same as having a good entry strategy. So I think the different managers kept on separating the obvious fact that the entry point is correct, but the entry strategy differs depending on the risk appetite of the client, depending on the mandate, and etc. And I think it will become a little bit clearer as I go in through. So I think the reason also why there was a lot of noise or a lot of emphasis around separating entry points from entry strategy really comes down, Pierre, to the fact that in the short term, it was very obvious that no one knows what's going on. But if you take a medium to long-term view, there is clear alignment that capital should be moving towards the direction of buying as opposed to selling. And then if we look at nominal bonds in that asset allocation discussion, I think there was quite a lot of empirical evidence to show that when you, of the prospective two-year return, when you enter into long-dated bonds at different yields, and the current yield range of 11 to 12% historically, if you buy now, which is a good entry point, it has come with a return of about 15%, which is pretty much an equity type return, or else equal. However, even with all of this evidence, the caution of a macro environment that is pretty much going through its worst point now was more than emphasized. So again, speaking to the balance of entry point and entry strategy. Inflation-linked bonds were not commonly referenced across the fixed income managers. The most negative, I think, that came out of that was that the mechanics of how this asset class is pricing is often very confusing for the average investor or for the average asset allocation committee. And also liquidity was noted to be a bit of an issue. And then also the captive market by insurers and banks and etc., which also caused pricing inefficiencies to the disadvantage of the average investor were noted as the most negative points. But on the positive front, the current real yields of about 4% on the local side and about 1.5% to 2% were noted as very attractive points, especially for CPAP's mandates. And I think in a lot of cases, for the scenario where inflation proves stickier for longer than anticipated, the importance of an allocation to inflation-linked bonds was also well emphasized. On the credit side,
can I come in there, because that was the
Yes.
question I wanted to raise, the one of inflation-linked
Sure.
bonds, and as you say, I think it's worth emphasizing that the managers indicate that inflation-linked bonds is not such a simple instrument, if I can put it that way. There are
Sure.
intricacies, and it sounds as if there's maybe good reason to leave that exposure to the flexible type managers that does it on one's behalf, as opposed to buying, say, an inflation-linked bond on a standalone basis, or inflation-linked bond fund, because they don't necessarily behave like you expect them to behave, kind of in a naive fashion. Would you say that's an accurate assessment?
Yes, I think one of the speakers did mention that point. So it was a bit of a divided asset class, Pierre Mas mentioned, but definitely the point you raised was raised because of the complicated technical side. Definitely. But I think also there were other speakers that equally embraced that if you've got a CPAP plus 3, 4, 5 mandate and you can lock in CPAP plus 4 without capital gains, that's not an opportunity to miss out. So I think it was really a balanced and a divided asset class, if anything. Great. And then I think on the credit side, the risk appetite for local credit, I can say it was generally on the hesitant side, but it was also very obvious across the conference that a lot of local corporates were noted to be issuing debt offshore at very attractive yields. So when it was about global credit opportunities, the risk appetite was a little bit more accommodative, but on the local side, it was very restrained, I think, across the panel. Coming to real estate, and I'm going to cover real estate on the local side and on the global side, I think the most important point noted was that 2022 was noted as one of the worst performance ever for this asset class. And it was also noted that the amount of pessimism, or the degree or extent of pessimism that has been priced into global property as well as local property is presently much worse than the pessimism that was priced in during COVID era. So again, just suggesting that the extent to which investors have become negative on this asset class is a little bit on the extreme side, or is becoming an outlier. It was also noted that the current price to NAV or book value is around 40%, but many transactions that have happened in this sector since 2020 are happening at book value or higher, again, just reflecting how much pessimism is in this asset class. One of the managers, specifically to be specific, actually had a stage 4 Eskom risk-adjusted IRR over the next 5 years, pretty much, I think, giving an estimate of roughly 15%. And I think this is where now the issue of entry points being good for every one of these asset classes, but the entry strategy being different, I think becomes very clear, because if you look at the potential prospective returns of local and global bonds at 15, local global property at 15, IOBs without any capital gains at CPI plus 4, it pretty much presents an opportunity where you can pretty much hold a lot of these ideas at fair value. But I think the uncertainty over the next 12 months means how you enter is going to depend, is going to be a little bit more critical. On the global side, I think a lot of the debt issues, refinancing worries were noted to be far more of a concern for the private opportunity or the private real estate sector. But in terms of the public listed market, it was noted that a lot of those companies had strong balance sheets, loan to value ratios were very healthy. And I think a good graph was given by Retweet, where they show that every time there's a very significant divergence between public real estate and private real estate, typically it has marked a very positive inflection point for public real estate, which is pretty much where we play in. So I think if you look at the asset allocation argument that was given, Pierre, I think you can confirm one thing. This is no longer the obvious funding tool for equity or for growth assets. If anything, all of these asset classes are demanding a fair allocation based on their strategic asset allocation, or in simpler terms, it's become extremely difficult to underweight a lot of these fixed income asset classes because there's convincing arguments for each and every one of them. The last two ones is your state-owned enterprises. Most managers were very lukewarm towards this asset class, and whenever it was mentioned, pretty much the importance of careful stock selection was significantly emphasized. And then in terms of the other fixed income ideas, such as convertible bonds, structured fixed income, your preference shares, I think a lot of the non-traditional players highlighted that there is quite a lot of attractively valued opportunities that are valuable. So if I have to maybe conclude on fixed income and real estate, here I think clear, attractive entry points across many sub-asset classes, but the entry strategy was mentioned is extremely critical, which is where I think you need your managers as well as your DFMs to help with that. Portfolio construction differences at the early stage of the cycle versus the late stage of the cycle is something that was emphasized every now and again. And then I think finally, there's too much pessimism into real estate, which again also makes it one of those asset classes worth, I think, increasingly building up exposure to. So this pretty much, I think, marks the end from my side on the local fixed income as well as real estate. I'll hand over to you, Pia, and if you've got any questions or areas you may want to emphasize further.
Thank you, Tavonga. Thanks a lot for that good overview. I think I'll keep additional questions maybe for the end in the interest of time. So I'll briefly cover what was said at the conference regarding SA equity and regarding passive investing and regarding hedge funds. There was an interesting session on hedge funds and also balance funds. So what I want to start with is actually the session on passive investing. That was on the second day because although the topic was passive investing, certain things were said that I think are almost universal truths that are worth keeping in mind when constructing an investment portfolio or thinking about a client's investments. And the interesting bit really came from 10X Core Shares from Gareth Stobie for me. And he said that you need to follow a proper process with your investments, and then you need to trust that process, and it needs to be well structured and long-term based. So what was pointed out was that there are things as an investor or a fund selector that you can't control. You can't control short-term market movements, for example. That's just kind of noise. You can't control macro events. You know, that might always influence you. You can't control company failures or instrument failures, you know, on the credit side. And you can't control, if you're a fund selector, whether a manager might experience drift in his style or whether there might be some sort of failure at the manager. But what you can control is the more structural and process-oriented things. So you kind of know over the long term what the risk premia from asset classes are. You know, if you look at long enough periods of time, we know typically over a 5 to 10 year period what each asset class will deliver, and that you can use to do your strategic asset allocation. And that's the part of a portfolio construction that you can control. You can also control the diversification in your portfolio, and you can control the cost. And that's where the discussion of the use of passive instruments and factor-based investments came into it. So, you know, to reflect on that is to say, build a resilient portfolio by getting the strategic asset allocation right, getting the diversification right. You know, that's the only free lunch in investments. Control the cost, because there are instruments that allow you to do it, and even your selection of active managers you can take that into account, and be aware of your factor or your style exposure, and that ties back to diversification. Don't expose your portfolio to a particular style that might be out of favor for a period of time. At the very highest level, we can observe that value had a very tough time since the financial crisis over a fairly long period of time. Now, if you had a significantly value skewed portfolio, that would have given you a hard time. But these things go through cycles, and you need to make sure that you have the exposure in the portfolio to capture it when it comes into favor. So I think that was the learning from that session regarding passive. Anthony Ginsberg from BCI Global also presented, and he showed a number of very convincing slides of how active managers typically, especially over the longer term, underperform passive indices. And I think it's not to make the argument about what's better, passive or active, but it is to say that active management is a challenging endeavor, and that's why active managers charge fees for it, and why successful managers who deliver high alpha can charge higher fees, because it's not an easy thing to do. And he showed that over the short term, half of active managers typically underperform, and over the long term, up to 80% or more of active managers underperform the indices. And that tells you that it's hard work for a asset allocator, consultant, or a DFM to find good managers, and even for an investor and to find consistent managers. It can be done, but one must be very selective. So in terms of my introduction of that session, I said that one must not think about active versus passive, but you must look at the research that came out of BlackRock, for example, that said the future of investments will really be about passive plus factor investing plus high alpha active investing. And each of those have a strength to play to, being cost reduction and the delivery of kind of multi-factor, well-diversified exposures on the passive side, and then true alpha from active managers. And I think at BCI and in South Africa, we are blessed with many boutique managers that are essentially high alpha delivery managers, and they play to that high alpha component of a portfolio. If we move on to the SA equity presentations, then there was quite a number of presentations. In total, I think 8 managers presented on SA equity portfolios. And the theme, and I think that ties to what Devonga also discussed, the theme was very much one of each of them had to pick a tagline for their presentation, and the themes and the taglines were things like managing risk in an SA equity portfolio. So really putting a focus on risk. And that was Alan Gray, by the way, that spoke the whole presentation about risk management. Other themes were investing in an environment where the macro dominates. That was pretty much the theme from All Weather. And then also being very selective in how you go about doing it. So there was a number of interesting things that came out on the theme, on the themes for SA portfolio site, and I'll cover that quickly. Fairtree, Chantal Baptiste raised something interesting in their presentation, and what she talked about was how they think about their portfolio in terms of the different time profiles or time periods. So she really spoke about what do they view as the themes for the short term and the medium term and the long term that might make money, or they hope will make money in the portfolio. And when I reflected on that, I thought, that's an interesting learning for an investor as well, that you can think of your portfolio in terms of what do you think is the high probability things that will give you a decent return in the short term, and it might be the bonds and the fixed income, as Devonga indicated. And then you can think about the medium term, what has an above average probability of delivering a good return, and then the long term structural things that you want to be exposed to, like climate transition, for example, and what can benefit from that. And there you might have to wait a long time for the returns to materialize in your portfolio, but they will. And I think in that bucket, I will also include maybe emerging market exposure, we know that the typical cycle of emerging market over or underperformance of developed markets is anything between 8 and 10 years. We've now been in an extended cycle. So I think that's a good long-term opportunity where if you are exposed to emerging markets, it's very uncertain whether you're going to get the returns in the next 6 months or 12 months or a year or two. But if the long-term cycles are going to hold and re-exert themselves, then there might be a multi-year period in the future where emerging markets outperform developed markets. And that's one of the things that one can put in the long-term bucket of a portfolio and position yourself to benefit from. And that's typically what we try and do in the BIP portfolios, where we do have meaningful exposure to emerging markets and China. But just in terms of Fairtree, what they've identified is in the short term, the interplay between inflation concern and the recession concern creates certain opportunities. And they mentioned gold and gold miners specifically. Their medium-term opportunity is very much around China reopening. And for example, they showed a slide where it was illustrated that Chinese tech have, because of the regulatory pressure, been lagging US tech, and there can actually be a bit of a catch-up in the China tech complex. And the long term, as I already mentioned, they talk a lot about global energy transition and how one can benefit from that. And I think that's by and large, a positive story for South Africa as well. They refer to the metals that are important in energy transition, and an interesting stats that was given was an example that to go to net zero in terms of climate targets by 2015, the world will have double the amount for copper compared to the amount of copper that was produced in the last 3,000 years. So we're going to need more copper in the next 25 years than what was actually produced in the last 3,000 years. Now, production side limitations might mean that that's very supportive for the copper price and the price of some of these other rare metals that you need to electrify the world, and that will create investment opportunities for portfolios. So that was an interesting thing that came out from their presentation. They do focus currently on high quality defensive positions. They do have cyclical opportunities. They are tilted to value, and they underweight low quality. So one needs to be, that speaks to the defensive elements in portfolios. Coronation was similarly balanced. They said that all the myriad headwinds in South Africa is well known, but it's the work of a portfolio manager to price risk, not to avoid it. And they make mention of the fact, and it does make sense to me, that bigger investment teams that can do proprietary in-depth research might give you an edge in South Africa if the South African investment conditions become really, really tough. And I think that's the reality. It's not kind of the beta will take you upwards and just deliver the returns. The need to be selective came through for all of these managers, and you really will need experience. That also came through in some of the presentations, and you will need to be adequately resourced. And maybe the third thing is that plays to boutiques is that you need to be nimble, because many of the opportunities, and there were some stock-specific opportunities mentioned, many of those speak to, very specific company examples where there are good opportunities. Investor gave an interesting presentation. They have net zero energy transition as a theme in their portfolios, and that make up about 22% of the equity portfolio. And they explained how you can play it. You can play it through green metals. The copper example was given. You can play it through renewable energy. You can play what they call transition opportunities. And what they pointed out there was that there are evidence that companies that improve their ESG are being rewarded with investor money, and that drives prices. So there are higher alpha coming from what they call ESG improvers. And lastly, the financing of transition to net zero. And that really speaks to the banks and the financial side. So there are good business done by the banks in terms of solar in South Africa and the financing of renewables, and that'll create opportunities. All weather, Shane Watkins did a very interesting presentation that was a bit more philosophical, and it was all about what they learned in the last 10 years. And he pointed out things like there's a wider range of outcomes these days because of the big influence of geopolitical events and even the influence of social media. And he showed a graph that just showed the number of geopolitical events that we experienced in the past number of years. You can talk about the Trump presidency and the trade wars that happened around that. You can talk about COVID. You can talk about the Ukraine war. It does feel like we've been experiencing geopolitical winds from all directions, and that did widen the outcomes. And again, you need a very astute and experienced manager to capitalize on that. He mentioned that position sizing is often more important than the position that you have. So that again speaks to risk management. He spoke about the fact that as these geopolitical events unfold, you need to respond more thoughtfully and less instinctively. So you need to stay calm with your investments and don't knee-jerk. He spoke about the fact that the increase in passive investments globally basically delays the occurrence of fundamentals exerting themselves. And that's a theme to keep in mind, that things can get skewed because there are increasing kind of effect of passive investing in the market that drive some shares up almost apart from what the true intrinsic value is, up to a point. He spoke about the benefits of smaller size, and I think that speaks to all the boutiques, and that you need to be more nimble. Anchor Capital was similarly on the cautious side. All the managers, and Anchor emphasized it, that SA valuations are cheap on the equity side, but growth is low. So the risk is that of value traps in the SA market, and therefore you need to be very careful. They did mention that a lot is in the price already in South Africa. A lot of the bad news in the price. If the energy situation and the load shedding situation, which is currently a significant headwind, improves, then it might well be that things like our retailers might actually be recovery plays in 12 to 24 months' time from now. So again, that speaks to selectivity. I already mentioned Allan Gray. They had risk management as their theme. Duncan Arthur spoke about the fact that SA is very dependent on buoyant commodity prices. We are very exposed to China. That could be a positive as China reopens and improves. But as they slow eventually their infrastructure spending, that can put pressure on South Africa. So one must also keep that in mind. And then regarding the bond yields that have moved up in South Africa, he did make the point that SA risk is being repriced. And it's unfortunately a reality of South Africa as we do ourselves no favor on the geopolitical side in terms of the risk that we delivered arms to Russia, that kind of talk drive up bond yields, and it actually reprices our country risk. And ultimately it will weigh against our investment prospects. So if you look at Allan Gray's top 10, for example, apart from 3 shares, the rest of them are rand hedge opportunities. And I think that tells you something about their caution about South Africa. Batelier also interestingly enough spoke about specific examples, but to me it tells you how selective you will need to be in South Africa. So they talked about ACI as an example where there might be merger and acquisition activities. ACI stand out compared to its global competitors, and there's an example of a company that might just be taken out by global competitors. Remgro has a valuation gap to NAV that can close, and a company like African Rainbow Minerals are just under-researched and therefore offer opportunities. So the theme among the SA equity managers was very much one of manage the risk properly and be quite selective about your exposures. Very briefly, balance funds echoed many of the themes of the equity managers, but across all the balance funds, the broad theme was underweight equity, SA and global equity, overweight more defensive opportunities, bonds specifically, locally, also globally. Interestingly enough, some managers underweight SA cash, still cautious on property by and large. And then interesting enough, many of the managers have global exposure around the 30 to 35% level. So they are not at maximum foreign exposure. And I think that's a reflection of the value of the rand, but maybe also the good fixed income yields in South Africa. A manager like Lorium is at 38% foreign exposure. So there's an example of someone that's a bit higher, but around 30% was a typical level for the balance funds. And then very lastly, very quickly from my side, there was a final presentation on the last day. I think it was about hedge funds, which is becoming very topical because of the coming regulatory changes that will make it possible to include hedge funds in CIS portfolios, also allowed according to Reg 28. And there were a number of managers that spoke on hedge funds, 361, Fairtree, Anchor, Visio, and AG Capital. And it was really a good high-level overview and primer about hedge funds. The important points to take away is there are different types of hedge funds. Not all of them are very risky. Some of them are quite conservative and conservatively managed and aim for capital protection and typically has a cash benchmark. Cy Jacobs from 361 pointed that out. So the types of hedge funds that we can access in South Africa are equity long short. Typically, they're a bit more directional and target beating the equity market. There's market neutral funds that try and deliver alpha without exposing you to market direction. There's multi-strategy funds that typically also have an absolute benchmark. And then there's fixed income hedge funds. And really, one needs to do your homework. Not all of them are very risky, but they do use gearing. So you need to understand the levels of gearing. You need to understand how the fees work, the performance fees specifically. You may need to make sure that you look at performance on a post-fees basis. But they can add value to a traditional portfolio, and there was an illustration of that by some of the managers. If you add it to a traditional balanced portfolio, it definitely enhances your risk-adjusted returns. But from our side, we do think it's a new space. It is a bit more technical space, so using a consultant or DFM and investing in a model of hedge funds or a fund of hedge funds is maybe the way to go, so that one controls some of the single fund risk or the single manager risk. And I think one can also focus on hedge funds that are extension of the long-only managers that you already know. So 361, Fairtree, and the likes are very well known as long-only managers in their own right. And one doesn't need to feel their hedge funds is something completely different from their long-only capability. It still feeds on that same process and that same philosophy, so it is partly known. So that was a quick whiz through, Tavonga, without much stoppage, about SA equity, balance, and hedge funds. Back to you for the final section on global equity.
Awesome. Thank you so much, Pierre. I'm going to just quickly share my slides again, and please just maybe help me to confirm, Pierre, as soon as you can see my slides.
Not yet.
Okay, great.
Yes, it's coming. Yes, can see it.
Okay, perfect. I'm going to try and go through this last section quite fast because I know that we sort of are fast approaching the end of our timeline. So I'll start off with on the quality front. I think the key message of at the last conference really came around how some of these stocks were really starting to look quite pricey. Whereas this time around, I think the sell-off that we experienced for March of 2022 sort of allowed a very good reset for this particular opportunity set. And I think a lot of the managers that subscribe to this way of stock picking were very, I think, clear around sort of, if you look at the two charts that I have in front of you, the one shows how the fundamentals of quality, meaning the cash flow return on invested capital, actually have improved during this period of inflation. And I think the underlying basic translation there was that these are companies that have built strong moats around the activities they participate in the economy. and they've got very meaningful pricing power, and are probably the reason behind the higher prices that we're struggling with today. And I think if you sort of look at the other chart, I think to the right, it also shows how those quality fundamentals, despite the stocks being sold off, have actually improved quite significantly. So I think on this particular part, I think the key message was that the reset allowed for valuation risk adjustment at the same time that the fundamentals for these companies have improved meaningfully, and the value and the current valuations are underappreciating that. So essentially quite bullish on the outlook for quality, or else equal. And then I think one of the managers, North Star, came in to also say, if you start to overlay valuation risk on quality, you improve the risk return outlook quite significantly. So I think the convergence of derating plus the improving fundamentals really being, I think, argued as an opportunity on a forward-looking basis. And I think this particular chart just looks at the risk upside versus downside profile of pure quality, which is pretty much the red bar, pure value, which is the blue one, the all country world index, and then finally like the combination of quality and value. And I think what this also means from a DFM's portfolio construction perspective is the argument that came across a lot of the value managers to say what happened in the sell-off of last year is finally allowed a typical global value portfolio to actually have much less cyclical or much lower poor quality companies because of what happens. So I think it's a win-win for quality, it's a win-win for value, or else equal. And then if we move on to the growth style, I think one of the things that really came out so powerfully was the confirmation that the sell-off of last year was indiscriminate. It did not really distinguish between a good growth company and a bad growth company. And I think the argument was that in this year, the market is really struggling to properly distinguish good growth companies from bad growth companies. And some of the managers were saying when they stress test their high conviction ideas, some of the things that are coming up from the fundamental research is that most of the fundamental growth investment cases are still intact. Many are actually now in a position where they can achieve their growth targets much faster than the current market pricing suggests. And then many will achieve growth rates that are higher again than what the market pricing suggests. So essentially, again, being positioned as an opportunity set where the true good global growth companies are now available at much, much better entry points than in any other point in the previous cycle. So I think the theme I picked up from fixed income, where many managers are really arguing that they can see good entry points in the different areas they participate in. I continue to pick that up, I think, from the global equity section, or else equal. So at this particular point in time, you're sort of seeing a good starting point for growth managers, a good starting point for value managers, and a good starting point for the quality managers. Pretty much, I think, well balanced optimism rather by all the managers, all else equal. And then if you sort of move into Japan, which we position pretty much as a subset of the value style, again, it really does show that if you compare value stocks to growth stocks in Japan, they're pretty much at the historical extremes in favor of value. And this is, again, the same chart that you see if you look at global value versus global growth. And there was quite a nice insight that came out of the Japan manager where they said, if you do a performance attribution of global growth and versus global value, many of the historical time periods where global value has done extremely well, much of that performance has come out of Japanese equities. So pretty much, I think what I'm doing here is just lumping up the profile and the insights for global value to what we picked up from global Japan and from Japanese equities. And I think you sort of get the same message. So I think what is becoming very clear, which was quite interesting during the conference, was that for a DFM that relies on a very diversified range of opportunities, what is happening today is that you can actually create a portfolio that is well represented across the different areas. And I think portfolio construction has become, I think, so optimal. I think gone are the days when it was so skewed in favor, especially of the large cap growth stocks against the rest of the world. So if I maybe just try and do a very, very quick summary, because I suspected I'll sort of be out of time. If you look at managers like Credo and T. Rowe, I think they expect the value cycle to continue. The strongest story, I think, argument I can put up across for this is that the typical traditional value sectors that were cheap even as the global mega caps are dominating the space, remain very cheap with very good upside, but with a strong advantage that there's a few good growth companies that have fallen into the value basket, and they're very good quality companies that have also come into the value basket. So all of a sudden, it is a strategy that has got much better diversification potential. And then obviously, if you look at managers like, I think Contrarius, what they were really quick to point out was the importance of starting to discern your long cycle, profitable inflection cycles, and they were picking up a lot of these outside of the S&P 500, especially I think in areas like the shipping industry, energy industry, and etc. And then I think Japan. So again, on the value side, or the value bucket in general, you had managers like Sense Capital, Orbis, Rescue, really, I think, re-emphasizing the strong valuation arguments, good macroeconomic backdrops that have characterized this set of ideas, all else equal. And then I think when emerging markets, I want to speak of emerging markets more from a DM versus EM perspective. And I think one of the managers that sort of allowed, I think, us to appreciate that really well during the conference was Sense Capital, where they pretty much, I think, started by arguing that when you're talking about emerging markets, you have to think wider than the MSCI Emerging Market Index, pretty much saying that MSCI Emerging Market Index only has about 1,300 stocks. But when you look at the true emerging market opportunity set, there is significantly more opportunities outside what the MSCI represents. So pretty much they strongly argued against how unrepresentative and how inefficient the MSCI EM index is in and of itself. And I think, Pierre, you will recall, these are some of the arguments I think we've always made very aggressively for ideas like China, where a big part of the China mainland index is not really well represented in the MSCI. And again, this is something that would have come in quite strongly from the discussions that came out of Rescura. So I think here it was really a case of saying, first of all, be careful or think carefully what you mean when you say in EM, because typically that starting point is fundamentally flawed whenever these debates are sort of taking place. We then obviously put Sense Capital on the spot just to talk about the current upside of the EM versus the DM. And I think they did mention that they seem to have a much better upside for the EM. However, they were also very quick to point out that this, in any case, does not mean that one is preferred over the other. Within their global equity portfolio, despite the EM capability, for example, having more upside, they still had about 25 to 30% on the EM, sort of, I think, suggesting that the discussion is a little bit broader than that. So I think there was just pretty much discouragement of positioning global equities EM versus DM. I think there's ways to combine that pretty much, I guess, in the same way that you talked about the importance of thinking about active and non-active strategies. I think Lenzo Trade, I think, kept off reminding us of the earnings growth potential of the typical companies they hold, and how many of those had almost double what your typical company has. And in this environment where there's concerns around earnings growth, that becomes a place you sort of want to have. And then I think finally, I think Blue Alpha again kept on talking about the same thing: strong balance sheet, strong earnings growth outlook. And in some cases, these were starting to come in at slightly better valuations, and the fundamentals obviously have improved because these stocks have pricing power. And then I think Adrian Clayton, actually, from North Star, also making the point that it does take a while for monetary policy to sink in. So whilst all of these arguments are very valid, there's also, I think, a macro picture that is pretty much hard to discern for the average person. So if we look at the outlook, I think it's great to appreciate that from a pure bottom-up stock picking perspective, Pierre. I think many of the managers are finding exciting stock picking opportunities. So it's a very interesting time where the discussion around bottom-up opportunities is clearly bullish, clearly constructive. So I think you cannot, dismiss that across all the managers. What is also very clear is that many of them could not commit to a specific short-term view. Many of them acknowledge that in the short term, there's quite a lot of uncertainties, and in the short term, there's quite a lot of downside risk. And I think this particular chart also coming through from our North Star was quite instructive to almost say many bull markets start when you've got very high real yields, and when you've got low real yields, it's typically more prone to bear markets. And if you look at this particular chart, you can see how your present real yields pretty much do not point a necessarily constructive outlook at the overall beta level. So it became a bit of a sweet and sour panel where there is almost acknowledgement that at an overall index level, things are not as constructive, but from a bottom-up level, there's a lot of good ideas. And I guess, yeah, this really speaks to the stance then taken by the multi-asset managers where they are buying into the strong bottom-up opportunities, but the total level of risk is still on the low side. And I think you sort of see this coming through. So if I have to sort of maybe give a very quick conclusion, it looks as if, or it sounded as if, the most constructive thing to come out of 2022 PR was that it reset the playing field. Pretty much every investment style has got a good set of bottom-up opportunities. Many of them have got balanced risk-return prospects, so you're not really creating cyclically skewed portfolios anymore. And for a DFM like us, it really means that we can actually now allocate to all the drivers of performance that we like from a multi-management perspective without worrying about skewed risk return profile. I think it was also clear, I think from everyone, that I think the downside risk in the late stages of the cycle are quite elevated. But even with that, each and every person had very convincing logical arguments of how the stocks they pick could still weather through the late cycle challenges. So for quality, it was pricing power. For growth, it was the declining bond yield and the strong growth profile they have. For value, it was the much better balanced universe because of the resetting and how the traditional cyclical opportunities are well supported by the greenification approach, pretty much similar to my arguments you noted from Fairtree. And then for emerging markets, the China reopening, most of the central banks are ahead of the inflation curve. They've managed their debt a lot better. So essentially, I think if I can take anything out of this is that from a manager selection perspective, as long as you've got a good manager, there's ample bottom-up opportunities, and the DFM just needs to manage the upside or high beta risk through asset allocation, where I think it becomes a case of like entry points, great for everything. Entry strategy must respect that the short-term risks are still skewed to the downside. So I think this is pretty much how I would close my section. Pierre, I'll check if there's any additions you may want to make. Yeah, otherwise I'll probably also hand over to you for the close.
Thank you, Tawonga. We're almost at full time, but it was a whirlwind. We tried to give you the highlights and the interesting points from 3 days of conference and more than 50 speakers in 45 minutes. So thank you that you kept up with us. But if you want to discuss any of what we talked about further with us at BIP, you are very welcome to contact us. We can certainly discuss it further with you, or if you have specific questions about some of the underlying managers or their views on what they said, you are welcome to contact the BCI sales team, and they can get your questions through to the managers and get answers for you. We did also record the session, so you can access it on the BCI website for Boutiques on Wednesday if you want to listen to it again. And also, if you want to recap on the conference itself, you can still access the conference website, and the recordings and the presentation slides are there. So you can either do that, or you can review this session on the Boutiques on Wednesday site. But like I say, you're also very welcome to contact us if you want to discuss anything further. And then just a last reminder about the next Boutiques on Wednesday, next Wednesday, the 31st of May. We will again be discussing SA equity, which is topical. It's a large part of all the Red 28 portfolios. It was a large part of the conference as well. So it'll be good to listen to SA Equity again. And that's going to be moderated by Brendan de Jong from Portfolio Metrics. So from my side and from Tawonga's side and from BIP, thank you very much for joining us this morning for this overview. We know it was quick, but we hope that you have a good high-level overview and a sense of what the temperature and the views at the conference were, and we hope that you got some interesting stuff out of it. Thank you very much for joining us, and enjoy the rest of your day and the rest of your week. Goodbye.